Welcome everyone. We're going to go ahead and get started with our workshop now. I hope everyone had the opportunity to get out and enjoy this top 10 day we had today. With everything that's going on, it's sure nice to get some good weather to kind of put a buffer to what is going on with the pandemic we're dealing with right now. We want to thank everyone for their attendance today, and I would like to start with you visualizing this dollar bill as your entire retirement nest egg. It's everything you've saved and put away and gone without the past 40 years. It's your 401ks, it's your IRAs, it's your pension plans, and it's your Social Security. It's everything you have, and it's the only thing you have to get you through the next 30 years of retirement. But the problem is you don't own this full dollar bill because you have some silent partners. One of the silent partners is when you take money out of your 401ks, IRAs, all of your accounts. It could create some taxes. This is fake, by the way. One of those partners is the IRS, right? They're going to take a piece of what you've saved really hard. The other piece that's going to get taken is by inflation. Inflation is going up. Healthcare, which is going up 3 times the rate of inflation, and will be your largest expense in retirement once it's piece. The kids move home and they want their piece, and this is where we are typically doing these workshops in person rather than online, and typically I see head shaking. Nope, that's not happening. And the stock market plunges 30% like it did earlier this year. And this is your piece. This is what you have to get you through the next 30 years of retirement. Folks, we have a crisis. You came here tonight to learn how to put the pieces back together. And specifically, we're going to be visiting with you about Social Security, because Social Security provides the bedrock for everyone's retirement. So let's get started. The goal is to educate you on Social Security and retirement income planning and provide you an introduction to the planning process. Some preliminary thoughts. Social Security is very confusing. All you have to do is think back to who created the Social Security Administration, and it's the US government. Some of the things they have leave us scratching our heads. This is a good one. This, as I mentioned, provides the bedrock to everyone's retirement, and there's no do-overs. Once you make your election, after the first 12 months, you can't change your mind if in the first 12 months, if you change your mind, you can pay back the Social Security Administration and file a bunch of paperwork. Mistakes are very costly. We're going to show you an example of someone that came into our office a few years ago that it literally would have cost them hundreds of thousands of dollars had they made the wrong choice. We like to look at the retirement income structure as a 3-legged stool. The first leg is what we're going to be visiting with you about tonight, is Social Security. The other 2 legs are your personal savings and your IRAs, your 401ks, all the money that you've worked hard to set aside. And then some of you may be lucky enough to have an employer pension plan. All a pension plan is guaranteed income that you can't outlive. If you don't have an employer pension plan, we can show you some ideas on how to create a private pension plan. A couple of housekeeping items. There'll be a pop-up that pops up a couple of times during the workshop, and the pop-up will look like this. And what this is we're going to be going over a lot of information, and we're not going to have time to answer a whole bunch of questions. We'll be answering a few along the way. but we're going to give you an opportunity to attend a complimentary strategy session with us. That can be done just by a phone call. Sometimes we'll do it with a Zoom meeting, or some folks like to come into our office. So if you would like to schedule a complimentary strategy session at any time, all you have to click is the schedule now. You won't, you'll continue to hear our voices and everything, and we can move on with the presentation. If you decide that you don't want to schedule the complimentary strategy session, all you have to do is click the X in the upper right-hand corner. The other thing is in the upper right-hand corner, you're going to see a couple of chat buttons. The one you'll want to click on it if you want to ask any questions is the private chat. Once you click on private in that upper right-hand corner, then you'll scroll down and you'll see Blake Neben, and you'll want to click on that, and that'll give you the opportunity to ask your question. It's important that you understand we're not affiliated or endorsed by the Social Security Administration. That's a good thing, because what you'll find if you call into the Social Security Administration or go down to the local office, you'll find that those folks are very friendly and for the most part very knowledgeable, but they're strictly prohibited from giving you any advice. So if you ask them, what's the best strategy for me? When should I take my Social Security? They'll say, I'm sorry, but we can't answer those questions. We're going to show you tonight how you can push the easy button, and we can help you with that. A little bit about us. Unified Legacy Advisors is the name of our company. I'm honored to be in business with my two sons, Blake and Seth. They'll be doing part of the presentation tonight. We're a family-owned and operated business. We're an independent, full-service, fiduciary retirement planning firm. We're A+ rated by the Better Business Bureau, and we have offices in Omaha and in Lincoln. Enough about us. Let's get to the agenda for this evening. The agenda covers 5 main topics. The first topic is understanding the basics about Social Security, and then we'll move into the Social Security planning process. Then Blake will come out and do some unique planning strategies and finish up with a sample report showing you how to maximize your benefits. And then I'll wrap everything up with threats to a secure retirement. The workshop is going to be approximately 45 minutes to 50 minutes. And as I mentioned, if you have questions, you can answer. We'll be answering the questions along the way, or at the end, we'll also be contacting you tomorrow, thanking you for your attendance, and we can answer any questions you may have at that time. Again, thanks for your attendance. We congratulate you on taking steps to increase your Social Security knowledge. So I'm going to have Seth come out and start his session.
Hey everyone, thanks again for joining us tonight. As Mike just mentioned, my goal is going to be to shed some light on the basics and rules of Social Security. Then I'll switch gears and talk a little bit about the Social Security planning process. This first section may be a refresher for some of you in the room. We just need to make sure everyone understands the general information before we move into those strategies to maximizing your benefits. We're going to start off by going through some of the most common questions we get in our office on a daily basis regarding Social Security. First question is, when can I file for benefits? For most everyone on the webinar today, you'll be eligible to apply for benefits at age 62, and your full retirement age, or FRA, will likely be in between age 66 and 67. Your FRA is just the age you have to reach to receive 100% of your benefit. As you can see from the chart here, it's based on when you were born, and it is monthly specific. You can find this chart at ssa.gov. Your FRA will also be listed right there on your statement. Some of you may have heard when talking with your friends, families, coworkers about Social Security that the best way to maximize it is to file right away at age 62, right when you're eligible. While this may be a good strategy for some individuals, it's almost never the best strategy for married couples. We'll go into why that is later in the presentation, why filing too early, especially as a married couple, can have major impacts on your benefits throughout your lifetime. So let's take a look at how your benefits are calculated. The calculation is fairly complicated. I'm just going to go over some of the basics with you tonight. The first thing the Social Security Administration is going to take a look at is your top 35 years of earnings history. So what if you don't have a full 35 years of earnings history? What they're going to do is replace any of those missing years with zeros, which in turn is going to lower your benefit amount. So when we begin planning, we may strategize some ways to eliminate some of those zeros, replace them with some earnings years to bring that benefit back on up. But back to the calculation, they're going to start with your top 35 years of earnings history. They're going to adjust those years for inflation to come up with what's called your average index monthly earnings. They're then going to feed that average index monthly earnings through what they call 3 bend points. That's just a tiered calculation ranging from 15 to 90% to come up with your primary insurance amount. Your primary insurance amount is just your benefit amount at your full retirement age. Now, I know this all sounds very confusing. Luckily, you won't have to calculate any of this on your own. You'll just want to make sure that your work history looks accurate and that everything on your statement looks accurate. We have seen some errors on that work history and people bring those in. You want to make sure and look those over carefully. This calculation hasn't been updated since Social Security began. It's always been designed to replace a lower earner's income rather than a higher earner's income. So the more money you make, the more planning you'll likely need to do, because Social Security may not replace as much of that income as you might have originally thought. Let's talk about inflation and how that might impact your benefits. So COLA stands for cost of living adjustment, and it's used to protect your Social Security income from the effects of inflation. If we look at some of the averages over the years, the average cost of living adjustment from 1975 to 2019 was 3.75% per year. If we look at a more recent time frame, 1990 to 2019, that average was a little bit lower, 2.41% per year. That's because interest rates and inflation were lower during that time frame. We like to use a pretty conservative rate of 1.5% in our planning, but bottom line is cost of living adjustment's a very good thing. Helps to make sure your Social Security benefit isn't worth less as you move further into your retirement. So let's take a look at an example of how this works. Let's assume you retired in 1990 and your starting Social Security income benefit was $2,000 per month. As you can see from the chart here, that amount is adjusted each year for inflation. By the end of 2019, that benefit would have risen to $3,974 per month. So as you can see, it is a very good benefit. I do want to make a note here in some of the more recent years, 2009, 2010, 2015, you'll see some zeros in there. The administration doesn't guarantee a cost of living adjustment every year. That's kind of why we like to use that more conservative rate in our planning. So now that we know that your Social Security income is going to keep up with inflation, but what about the rest of your retirement income? If the rest of your retirement income isn't keeping up with inflation, it's costing you money year after year, that's a question to consider very closely as you begin your retirement planning. This next piece is probably one of the more confusing aspects of Social Security. So can you work and collect benefits? The short answer is yes, you can work and collect benefits, but there will be a penalty if you've not reached your full retirement age. So for 2020, you'll only be able to earn $18,240 a year before being penalized. When I'm talking about your earned income, I'm talking about your W-2 income or your 1099 income if you're self-employed. The penalty calculation doesn't take into account any income from investments, annuities, things like that. So for every $2 in earnings above that $18,000 limit, $1 of your benefit will be withheld when you're under your full retirement age. Now, once you reach the year of your full retirement age, let's use an example of 66 and 5 months. So once you turn age 66, that penalty would be reduced. You'd be able to earn $48,600 a year before being penalized, and $1 of your benefit will be withheld for every $3 in earnings above that limit. Now, once you reach the month and year of your full retirement age, in this example, that's 66 and 5 months, there's no limit and no penalty. So once you hit that full retirement age, including the month, you can earn as much money as you want with no penalties on your benefits. Let's take a look at an example. Let's assume you're age 65, so you're before your full retirement age, you're working and collecting benefits, earning an income of $50,000 per year. After we take out that exempt amount of $18,240, we come up with a penalty basis of $31,760. Now remember that $1 of your benefit is withheld for every $2 in earnings above that limit. So we divide that number by 2. We come up with the Social Security penalty in this example of $15,880. As you can see, that's a pretty sizable amount. You want to make sure you're planning for this if it applies to your specific situation. So everyone's always interested in taxes, how much I'm actually going to get to keep. So when looking at the taxability of your Social Security income, they're going to take into account what's called your provisional income. The calculation's there at the bottom of the screen. It's half your Social Security benefit plus the adjusted gross income from your tax return plus any tax-exempt interest. So if we start by looking at the married filing jointly structure there, if your provisional income is less than $32,000, 0% of your benefits would be taxable. Anything in between $32,000 and $44,000, 50% of your benefit would be taxable. Anything greater than that $44,000, 85% of your benefits would be included in your taxable income. If we look at the individual filing rules, it's basically the same structure. They're just adjusting those numbers down to account for an individual. So now that we know how your benefits are taxed, what are some of the ways that we could potentially help you reduce the taxes that you're going to pay on those benefits? One thing we can do is reduce other income with tax advantage investments, but not municipal bonds, because remember, tax exempt interest is included in that provisional income calculation. We can anticipate IRS mandated distributions from your retirement accounts, which may put you in a higher tax bracket. Those are your required minimum distributions at age 72. Mike's going to touch on those briefly in the last section. We can delay Social Security, which would reduce the number of years those benefits would be subject to the tax. We can reduce expenses by paying off debt before retirement, and then just continuing to assist you with managing those taxes throughout retirement. So those are just some of the ways that we help our clients reduce the taxes on their benefits. It could potentially help you reduce yours as well. All right, so we just covered some of the basics and rules of Social Security. Let's switch gears and talk about the Social Security planning process. So how do we plan? Why do we plan? And what's the overall impact? So the first thing you need to consider when planning is your complete wage history. We touched on this when we went over the calculation. You'll just want to make sure that your statement looks accurate. Next thing we look at is your desired retirement age. Keep in mind, your desired retirement age may not match the age you decide to take Social Security. So when we begin planning, we have to strategize where we're pulling that income from until your Social Security income starts to kick in. Next thing we look at is your estimated life expectancy. We take a look at your personal health history, your family health history, come up with an estimated life expectancy to run the reports. We've already touched on inflation and cost of living adjustment. But finally, we'd gather information and statements from your other assets you might have earmarked for retirement. Some of you may have some 401ks, some IRAs, some brokerage accounts. The reason we do this is to identify any income gaps between what Social Security is going to provide and what's that overall amount of income you're going to need to maintain your standard of living in retirement. So Social Security is probably not going to provide all the income you need in retirement. For some of you, it may cover 60% of your needs. For some of you, it may only cover 20%. We won't know until you come in, sit down, and we begin developing a game plan together. So if you decide to take advantage of the complimentary strategy session, what's the process we would go through together? The first thing we would do is gather some information. We've touched on these 3 items here. We take a look at your wage information, make sure that's accurate, decide when you want to retire. Again, that may not match the age you decide to take Social Security. And then we take a look at your estimated life expectancy. This would give us the information we need to run your Social Security report. So after the strategy session, you'd receive your complimentary Social Security report. It would include the benefits of filing now versus filing later. It include any switching strategies. Those are strategies if you're a married couple that Blake's going to touch on in the next section. But most importantly, it'll include what's at stake. What's that dollar amount that's at stake if we don't put a good plan in place? A lot of our clients are really blown away by this piece. Sometimes hundreds of thousands of dollars are at stake if you don't put a solid plan in place. Finally, our clients tell us this last piece is probably the most important and helpful to them, and that's identifying the income gaps. So in addition to your Social Security report, you'll see what's called an income gap analysis. We'll take a look at your current income needs, your future income needs, and how to close that gap between what Social Security is going to provide and what's that overall amount of income you're going to need in retirement. So having a great Social Security plan is extremely important, but it's really not all that useful unless you identify those income gaps. So this is a really important slide. You have to understand that you need to coordinate your Social Security with your overall retirement income game plan. You have to consider it in the context of a lot of different things. Some of you may have a pension, you may have some retirement accounts, RMDs at age 72, any savings and investments, and your earnings. All of these things have to be coordinated and maximized to make sure you have the income you need for the rest of your life. Some of you may have already done this. If not, it's a great place to start. You can log on to ssa.gov, create an account, pull your benefit statement, look at some of the general information there on the website. This slide is probably one of the more important ones. It helps us determine how Social Security comes up with the early versus late filing and how that has an impact on your benefit. So let's take a look at an example here. Let's assume at your full retirement age, your benefit was $2,000 per month or $24,000 per year. As you can see from the chart, at your full retirement age, you receive 100% of your benefit. Let's say you decide to file early. Let's say you decide to file right away at age 62. As you can see from the chart here, there'd be a 25% actuarial reduction, so you'd receive 75% of your benefit. In this example, that's $1,500 a month or $18,000 a year. If we look at it the other way, let's say you decide to delay taking your benefits. For each year you delay taking your benefits, you receive an 8% guaranteed retirement credit up to age 70. So it's maxed out at age 70. So if you wait to age 70, you receive 132% of your benefit. In this example, that's $2,640 a month or $31,680 a year. Now, this isn't to say that taking your benefits early is always bad or delaying is always good. You just need to understand this before you can put a good plan in place. I do want to make a note here that the benefit dollars you see on the screen here don't account for any cost of living adjustment. So for example, if we look at age 68, you'd receive 116% of your benefit plus any cost of living adjustment on top of that. So it can be a very good benefit in most cases to delay that filing. So what is break-even analysis? Break-even analysis is just a common strategy we use in Social Security planning. There's been an argument that it's always better to start taking your benefits early because by the time you break even, you'll be too old for that effect to make any difference. The benefit of that is you're able to retire earlier while you can still enjoy the money. And that sounds great for a lot of individuals. But where this starts to break down is when we begin planning for married couples. So let's take a look at an example here. We've got Joe and Deborah. Joe is age 66, Deborah's age 63. As you can see from the chart there, there's a break-even point between two strategies. A current strategy of them taking their benefits right away at age 62 versus a delayed filing method that we put together for them. In this example, if Joe and Deborah thought that they would pass away prior to their ages 72 and 69 respectively, filing early would make the most sense for them. If they thought that they would outlive those ages 72 and 69, delayed filing would be the best option for them. In this case, they did choose that delayed filing, but this is just a report that's included in that complimentary Social Security report. All right, well, that is all I have for you guys tonight. I'm gonna hand it off to Blake. He's gonna go over some unique planning strategies and then tie everything together with a sample report and a demo of our software. I really appreciate your time. Look forward to speaking with some of you after the workshop. Thank you.
All right, good evening, everybody. As Seth just mentioned, my goal is going to be to shed some light on some of those unique planning strategies that are available for married couples. We're also going to go over some rules regarding some divorce benefits and also some rules regarding some of those survivor benefits. So if you've lost a spouse, there's some certain things that you need to be aware of in order to collect on your deceased spouse's benefit. Then what I'm going to do is I'm going to switch gears and go into a sample report to show you how to maximize your benefits. A couple of clients that came in following one of our workshops, how they were able to get some help in maximizing their Social Security and their overall retirement income game plan. So we get a lot of folks that come in, they've been divorced and they're confused on, hey, you know, I was married to this person and we're no longer married, but I think I'm eligible to receive Social Security benefits based on their work history. There's a lot of rules that you need to be aware of in order to do that, and we're going to go over some of those here really quick. So you must have been married to that person for at least 10 plus years. You must be currently unmarried, and you both must be at least age 62 in order to collect benefits based on each other's work histories. And you must be divorced from that person for at least 2 years. And your benefit as a divorced spouse is equal to 1/2 of your ex-spouse's benefit at their full retirement age. So if let's say I've got a benefit of $2,000 per month at my full retirement age, I'm divorced. My ex-spouse could collect 50% of that $2,000, so $1,000 per month based on my work history. More than one ex-spouse can receive benefits on the same worker's record. So if you've been divorced more than once, there's some strategies that go into that. Benefits paid to one ex-spouse do not affect those paid to the worker, the current spouse, or any other ex-spouses. We get a lot of folks that come into the office and they are worried that the Social Security Department is going to notify their ex-spouse that they're snooping around on them or receiving benefits based on their work history. No, that's not the case. As long as you have your divorce decree and their Social Security number, you're able to get that information direct from the Social Security Administration. I will make a note that recently in 2015, Congress did pass a bill based on some of these benefits. So certain individuals based on your date of birth still qualify for these. Some do not. So if that's a question that you have for us, we'd be happy to answer that on a call after the workshop to give you some more insight on that. We also get folks that come into our office that have lost a spouse. And of course, the Social Security Administration has allowed us to collect benefits based on our deceased spouse's earning record. And there's some rules, again, that go along with these too. The couple must have been married for at least 9 months at the date of death, except in the case of an accident. And you can actually start receiving benefits as early as age 60 under these rules, as opposed to traditional Social Security where you have to wait till age 62. And the survivor benefit isn't available if you remarry prior to the age of 60, unless that marriage ends up ending at that point in time. And this is a really important one, especially when we're going to be talking here in a few minutes about planning as a married couple. When one spouse dies, the other one gets to take over the higher of the two benefits, but they lose their own benefit. And so we'll show you the impact of that when we go over the sample study here in a few minutes. So planning as a married couple is really all about understanding spousal benefits, and spousal benefits are a very important part to the Social Security planning process. A lot of times these benefits are either misunderstood or they're just plain ignored. And what ends up happening is people leave a lot of money on the table that they could be putting into their own pocket, and instead they give that right back to the IRS. These benefits were designed when they first came into place to protect the income of the non-working spouse. And if you can think, clear back to when Social Security first started, many of those non-working spouses were women, right? They were at home taking care of the children. But as more and more time has gone by, more and more women have entered the workforce. And so they have a benefit of their own. So it's really important to know how to coordinate each other's benefits to get the most out of Social Security that you can. Some of the rules regarding spousal benefits: the spouse must be married to a worker for at least one continuous year before applying. The worker must be entitled to benefits and have filed for benefits. And then I'll give you an example of how these work. Just like the divorced spouse benefits, let's say I'm at my full retirement age. I've got a $2,000 per month benefit. I'm married. My wife is at her full retirement age. She can collect 50% of my benefit at my full retirement age, so $1,000. If she'd like to apply for a spousal benefit sooner than her full retirement age, she could do so as early as age 62, but she's going to receive a reduced amount of 35% of that $1,000. And lastly, they have made some changes to this benefit as well. So certain individuals based on your birth date still eligible to use these. That's why we bring them up in this workshop. Some are not. just talk to us after the workshop if you want to find out if they apply to you and if you're eligible to use them, because they're a really big thing. I know that this slide looks really familiar, as Seth just went over it a few minutes ago, but I want to talk for a minute about what most people do. And most people have no special filing strategy. The husband might file for his benefit at one age, the wife might file for her benefit at another age, but they have no plan in place for when the best time is to file that's relative to the other person. And again, what people end up doing is leaving a lot of money on the table. Just naturally, we all listen to the people that we trust the most, right? Our friends, our family members, maybe a coworker. And a lot of times they tell us, hey, you know, I filed for my benefits right away at age 63 or 62, and that worked out fabulous for me. That couldn't be further from the truth for the best way for you to file for your own benefits, because you do not have the same expenses that they do. They may have retired at a different point in time than you did, or maybe they have you know, less assets saved and they needed to turn that on sooner than allowing it to delay. So it's very important to understand that it's like a thumbprint. We all have a special plan that's customized to us, and for us to turn on our benefits at the right age. Filing restricted application is just a very common term that we hear within Social Security, and all that filing restricted application means is taking a spousal benefit. So if we go back to that example of my wife and I have a benefit of $2,000 per month at my full retirement age. My wife wants to file restricted based on my work history. So she's going to take that $1,000 per month, and she's going to delay her own benefit and get those 8% delayed retirement credits. So she's going to let her benefit cook. And then at age 70, she's going to switch over to her own benefit, which would have been much greater than if she took her own benefit back at age 62 or 63. It's a great way to get some money along the way. Let yours cook until 70 and then switch over. It's a great strategy if you're eligible to use that. This is a very important slide when we're talking about combining strategies. So let's assume that we have a married couple. There's 9 different years where the husband can file 62 to 70, 9 different years where the wife can file 62 to 70. If we multiply that by the 3 different filing strategies, on an annual basis, that's 243 different combinations. But on a monthly basis, that's over 2,900 combinations. And the reason why we talk about it on a monthly basis is because Social Security is monthly specific. If you file for benefits 3 months prior to your birthday versus 3 months after your birthday, you're going to receive a different amount from Social Security. So it's important to get it right the first time. As Mike mentioned, there's no do-over. So it's just easier to get it right the first time and know that you're on track for the most Social Security that you could get throughout your retirement. Okay, so we just went over some of those unique strategies. Now what I'm going to do is I'm going to move into that sample report and show you how some folks that were in one of our workshops came into our office afterwards and were able to get some assistance with their planning. So Joe, he's age 66. We found out when he brought his Social Security statement in that his benefit was just over $2,400. He wanted to use a life expectancy for himself of age 87. He's married to Deborah. She's 63 years old. Her Social Security benefit was slightly less than Joe's because she was out of the workforce for a number of years, but then got back in. So she has a benefit of her own. And they wanted to use a good long life expectancy for Deborah of age 90. So in addition to having them bring in their Social Security statements, we also asked them to find out how much on a monthly basis does it take to take care of all of your expenses. So your food, clothing, vacations, gas in the car, all of those types of things are very important to understand prior to entering in retirement. For them, it was $6,500. So what we were able to do is show them, what if they took benefits right away at age 62? How much money was at stake versus what if we utilized a different strategy that we were able to come up with that maybe have gotten them some more money from the Social Security Department. So what you're seeing here is just a printout of just one of the reports that we go over with everybody. And for Joe and Deborah, we're showing them both applying for their benefits right away at age 62. As you can see down in the legend there, the dark blue is Joe, represented on an annual basis. On top of Joe's benefit is Deborah in the light blue. And we've got their life expectancies moving out there down on the x-axis, and then up just a little bit from those bars is the cost of living adjustment that we're using of 1.5%. So if they both applied right away at age 62, Social Security would have paid them out just about $1 million over their life expectancies. And they thought, wow, that's a lot of money. And it is a lot of money. As everyone knows, we're living much longer lives into retirement. So this decision that you're making here becomes extremely important, because you want to make sure that that benefit is high enough to take care of your income when you're 80 or 90 years old and still living. So what we did is we showed them right away at age 62. And then we said, do we really need to turn on benefits right away at age 62? Or what if we did a delayed filing strategy? So we showed them a way for Deborah to apply for her benefit at age 63. Then Joe, he's going to file restricted on Deborah's work history. And then at age 70, after Joe's benefit is cooked, he's going to switch over to his own benefit, which grew much more significantly than if he would have filed clear back at age 62. As you can see, instead of having just over $1 million left that was paid out over their life expectancies, now we've got just over 1.5 million. So you can see the significant amount of money that's on the table if you make the wrong decision. It can be a lot of money that you leave on the table versus looking at all of the options that you have and then making an educated decision at that point in time. This is just one of the printouts that we provide everybody once you decide what strategy is the best strategy for you from a Social Security standpoint. So in August of 2018, Deborah filed for her benefits. August of 2018, Joe filed restricted, and then in March of 2022, Joe went ahead and switched over to his own benefits. So you can see it is monthly specific here, and it gives you the exact date on when the optimal time is for you to apply for Social Security. As Seth mentioned before, having a great Social Security plan is very important, but also understanding those income gaps. How much Social Security is going to be coming in on an annual basis versus how much income do I need in retirement? And as you can remember, Joe and Deborah, they needed $6,500 per month to take care of all of their living expenses. So the blue bars, what they represent is the Social Security income coming in. And it's doing that funny step pattern there because we're utilizing that filing restricted method. And that's the one that they chose so that they could get more as they continue to live throughout retirement. So those are the blue bars. The red bars, what they represent is that $6,500 per month that they need in order to pay for all of their expenses. And those red bars are going up kind of like a stairway there, because we have to take into account inflation. You only have to think back to, when did I purchase my first vehicle? How much did that cost? Versus when did I purchase my last vehicle? How much did that cost? To see the impact that inflation has on our money. So those are the red bars. They have an income gap here. And the last thing that I'll mention, you'll see that those blue bars down the road at age 87, we have Joe passing away. They're kind of dropping off there. You'll notice that because when Joe has passed away, Deborah, since Joe's benefit is higher than hers, gets to take over Joe's benefit, but she loses her own. So there's a reduction in income at that point in time that we have to take into consideration. These are just the numbers that back up that graph above, and I'm not going to go over all of them. We don't have enough time. But during the bulk of their retirement years, they're about 40% short in their overall income need. And so we were able to help them consolidate some of their other investments and provide some more stability on those guaranteed income columns that they weren't having to worry about, am I going to have enough money to live on? And is that money going to be coming in once I've stopped earning a paycheck? Okay, so we just went over that. The last thing that I want to go over before I turn it back over to Mike and we wrap up, I know we're trying to keep this, we're trying to keep our time limited here because we don't have a lot, but I want to go over our software real quick. So if you decided to take advantage of that complimentary strategy session in our office, how might we be able to help you make some of these vital decisions as you move into retirement? There's a lot of people that come into our office and they're asking us, when can I safely retire? When should I turn on my Social Security benefit? Are my expenses in line with how much I have saved in my retirement assets to take care of my income need? So that's what this software does. That's what it helps people do. So what I want you to notice is clear up here at the top, you'll notice that it says married, single, divorced, or widowed. And what I want you to notice is whether that falls into one of your specific situations, our software can calculate for Social Security based on those situations. And we would plug in your names, dates of birth there. We would plug in, do you own or rent a home? What's the value of your home? Do you have a mortgage payment? How many years are left on that mortgage payment before that drops off? And now I've got more income to use for my living expenses in retirement. We also have your total monthly expenses that we plug in, excluding that mortgage payment. And then these special expenses that pop in here are things like maybe you have a credit card or a car payment that you're paying off, but it's going to drop off in a certain period of time and isn't going to be around for a long time, or maybe a health insurance premium. And then we would plug in, are you still working? What's your current salary that you're earning? How long do you plan to work or want to work? Do you want to work a post-retirement job? How much would you earn from that? And how long would you want to work that job? And then we have to plug in our tax rates because we have to tax Social Security when we turn it on. We have to tax money that we take out of our IRAs and our 401ks when we draw money out of those. So we have to take that into consideration in our income plan. And then lastly, we would plug in your Social Security benefits. Do you have any pensions or other miscellaneous income, maybe from a rental property or some land that you own? And then also, what are your retirement assets? We have to plug these into different buckets because they're taxed differently when we pull money out. Your IRAs, Roth IRAs, maybe you have a 401k or a 403b plan through an employer. Do you have any personal savings in a bank account, other investments that you have in a brokerage account, or existing life insurance that's going to kick in when one of you passes away? So what that does is it pulls all of that information together and it gives us a complete cash flow plan. Not only does it tell us based on all of those assumptions when the best time is to turn on Social Security, it also tells us, do we have a good chance of being okay as we move through retirement? And we can move these dials around when you come in and play all the what ifs that you want. And as we move these dials around, what I want you to notice is up here in the far left-hand corner, it says what's left over to heirs. So for Joe and Deborah, they've got about $1.3 million left over to heirs after they've pulled money out from their assets. They've turned on Social Security, all of those good things. So they have a pretty good cushion. Their assets are continuing to grow, even though they're pulling money out of their accounts. So I'll just give you a quick example of how this might work. So you see this 1.3 million up in the far left-hand corner. If I move this dial out to age 95, now Deborah's living 5 more years. What you can see here is instead of having 1.3, now we only have 980,000. Deborah needs more income from her investments to live on. So that number has dropped down. Sometimes when we do that, it creates red in someone's plan. And so it's important to understand that early on. How do those types of things affect us? And do we need to make any changes early on before we have a disaster down the road? So those are some of the types of things that we help people out with and can answer questions on for you. All right, I'm going to jump back in here and back to the slides and the presentation here. And what I also want to note here is we always run a stress test in everybody's plan. So it's important to know that market cycles don't work in a static fashion. We don't earn a static 4% rate of return every single year. We all know that. We're going through a bear market right now where the market is down 30% in the first quarter. So what if something like that happens? So what we're going to do is, instead of having 1.3 million left over to heirs, we're going to plug in the rates of return for the S&P 500 in 2007, 2008, and 2009. And as you can see, in 2007, it was a +5, 2008, -37, and then we had a good rebound in 2009 of 26%. So instead of, if we run that into their plan, instead of having that 1.1 million left over, now we've got a shortfall in here. We've got a $23,000 shortfall at the end of the game if we assume a 4% rate of return in all other years and just substitute those rates of return that I just went over. So it's really important to understand how different market cycles and stress test your plan to make sure that you're going to be okay. All right. I'm going to go ahead and pass it back over here to Mike. But before I do, I'm going to give everybody a chance to sign up for that complimentary strategy session. So if you would like to do so at this time, you're going to see that little bar pop out there on the left-hand, bottom left-hand corner. Go ahead and click schedule now. Otherwise, just click the X. Thank you, everybody, for your time. Look forward to speaking with some of you after the workshop. Thank you.
Okay, thank you for hanging in there with us. I know when we do these live in person, it's a lot easier to stay with it. And at home, you got all the distractions and such. So at any rate, what I want to do is we've got about 7 more minutes is all. So we appreciate your attention. When I started my opening comments, I mentioned that Social Security is very confusing. We hope we haven't further confused you. The idea is that we wanted to that planning is extremely important. The statistics tell us that only 6% of people have a written game plan for retirement. And so basically, we think that's just kind of like winging it. And rather than having your ducks in a row, then you're rolling the dice to see what happens in retirement. And when times like this happen, when the markets are going down significantly, we get a lot of positive feedback from our clients when we are showing them their plan and the impact that the downturns in the markets have on their plans. And so it gives them the peace of mind in knowing, hey, things are still going to be okay. Keeps them from freaking out. So I'm going to finish my final comments here, just going over some of the frequently asked questions we get in our office. The first question is, am I going to be okay? We developed the software in order to give people the peace of mind and knowing what the numbers look like. We test it out mathematically, and we find out how the plan runs on a mathematical basis. And we as human beings fear the unknown, right? And so if we don't have a picture of what things are going to look like down the road, then we're concerned about what's going on. So the second question we get is, how do I protect my assets from a long-term care event? I'm going to just read a quick blurb out of the Lincoln Journal-Star. Long-term care costs are surging again, and the most expensive option, a private nursing home room, may soon top $100,000 per year. That's probably something that we need to plan for. That's a huge expense that's potential down the line. So we run that in the software to show what would that look like if we had one of those, and how would we deal with it? What if I'm not ready to retire is the next question. Doesn't matter whether you're 6 days, 6 months, or 6 years from retirement. We think planning as soon as possible makes a whole lot of sense. How do we get paid? Because we mentioned we would run a complimentary plan for you, and we don't charge fees for our planning. We get paid like every other financial advisors. We'll be showing you some options to what you're currently doing. If you like those options, then implement plans. That's how we get paid. And the last question is, what if I already have a financial advisor? And it's interesting because there's 2 distinct phases of your financial lifetime. The first phase we call the accumulation phase. That's when you're putting money into your buckets as you're going, taking money out of your paycheck, putting it into your 401k. In your accumulation, we're focused on growth and higher risk type of investments. Most financial advisors are accumulation specialists. Once you get close to your retirement years, then we think it's a good idea to start looking at your portfolio and maybe focusing more on income and lower risk type of investments. That's your distribution phase. That's when you're taking money out of those buckets. And they're two distinct phases, and it requires specialties of folks working in the accumulation phase or the distribution phase. It's hard to play on both sides of the fence. We play only in the distribution phase. So traditional financial advisors are growth and accumulation specialists. We at Unified Legacy Advisors are preservation and distribution specialists. The economic times we live in today are radically different than any in our history that we've experienced in our lifetime. We've had stock market volatility. The first quarter was a complete washout. We had the stock market going down for the first time significantly in a very long time. It was a reminder that we do need to keep our eye on the ball. Low interest rates. We've got interest rates dropped down to the bare minimum, and they're projected to increase. Why do I mention that? Because typically what we've done in the past is we've moved funds from our stock accounts to our bond accounts. But if interest rates go up, and I'm not trying to make anybody a financial expert, but what happens is your bond values decrease. That's why Warren Buffett says that bonds should come with a warning label. We have bond alternative investments that a lot of folks aren't currently using. Let us know when you come in if you're interested in that. How does that impact my nest egg? If you haven't paid attention to anything, and this is my last set of slides here. If you haven't paid attention to anything we've mentioned today, this is it. This is going to impact everyone on this call. What we're going to do is in our industry is we have something we call sequence of returns. All that means is, does it matter when the returns happen? We're going to put that to the test. And how we're going to do that is we're going to take $100,000 and we're going to put it in portfolio A. That's the tan section there. And we're going to take $100,000, we're going to put it into portfolio B. And that's the blue section. And what I want you to notice is the returns, and this is a 40-year-old individual that we're starting out with. I want you to notice the returns going down in the tan section, -12, -21, -14. That person experienced really bad returns early on. And then we can look at the blue section and we're going to read up. I've just inverted these tables. So -12, -21, -14 going up. And the interesting thing is that they both average 8% when we look at the bottom of the column. And the numbers are exactly the same. We've accumulated the same. We can scramble those during the accumulation phase any way we want, and we come up with the same number. Now let's test that in the distribution phase. So now we have our person who's 65 years old now. They've accumulated their $684,000. And now what we're going to do is we're going to start taking withdrawals, right? Because once you stop working, we're going to have to start taking distributions out of your accounts. And what we're going to assume is we're going to take out 5% per year and adjust that for inflation. And what I want you to notice is in the accumulation phase, it made no difference how we ordered those. Now we're going to take a look at the distribution phase. So again, the returns are exactly the same, -12, -21, -14. And then I've inverted that on the other side of the chart, same exact chart. And let's test to see if it makes any difference. What you'll notice is the person with the bad returns to start out with have run out of money at age 82, when the other person, when they're age 90, they have $2.6 million. And the important part of that is that early on in retirement and just before we retire are terrible times to have negative returns in our investments. We can't control the stock market, obviously, but we can control how we have our funds allocated. And the moral of the story is just don't lose the money. We want to make sure that early on we're not having significant losses, and things usually turn out very well. Just a quick bonus topic, the Secure Act. They delayed the start of the required minimum distributions. This was just effective in January of this year. They moved those from 70.5 to 72. So we don't have to start taking those distributions until age 72. They repealed the age limitations for IRA contributions. So now we're able to start continue adding funds to our IRAs if we work past age 70. And then the last significant part for the retirement side of things is they eliminated stretch IRAs. Now they have a mandatory 10-year rule with some exceptions like spouses and disabled children and some of those kinds of things. So they aren't allowing us to stretch that out over lifetimes anymore. If you decide to sign up for the complimentary strategy session, you'll receive a printed strategy to maximize your Social Security income, a comprehensive retirement income game plan, strategies to reduce taxes in retirement. Many of you know that age 72 now is a pretty special age, and you want to circle that on your calendar because that's when the IRS is saying, out of your 401ks and IRAs, we want to get our taxes. And if you decide you don't want to, or you forget, what they're going to slap you with is the steepest penalty they have on the books, and it's 50%, folks. This is something they're very serious about. So it's important that you understand that you need to take those required minimum distributions. We provide assistance with Medicare planning. We have all these different workshop topics, and what do those have in common? They're on the minds of those who are in or nearing retirement. We really thank you for hanging in there with us tonight. We're trying to get those that are wanting to watch the draft out of here, so we'll get you out. I'm going to pop up one more time the offer for the consultation here. I apologize. Here we go. So in closing, we think every one of you deserve to have a plan. And we think it's better to have a plan than to try to wing it. We don't want to roll the dice. We want to have our ducks in a row. And that's what we're offering for anyone. And if you sign up for the complimentary strategy session, we can just answer your questions if that's what you would like to do. Again, we appreciate your attendance. We thank you and want to congratulate you on taking the steps and getting educated on Social Security. If you do decide to do the complimentary strategy session, our promise is that it'll be the best hour or 15 minutes, however long you want it to be, that you'll spend this year. Thanks again. Hope you all have a safe evening, and we look forward. We'll be reaching out to you tomorrow morning to thank you for your attendance. You'll notice that the phone number we'll be calling from will be a Lincoln number. It's this number, 402-261-7089. Again, thank you. Have a great evening.